and this was the first of this fiscal year, the Reserve Bank of India signaled the continuation of its neutral policy stance, leaving the repo rate unchanged at 6.25%. The monetary policy corridor has been narrowed to tackle the excess liquidity in the system. Neha Bothra gets us the key takeaways, where inflation continues to be a big concern and draining of liquidity was the other focus area.
No fireworks, no surprises. Nothing out of the ordinary. The boss of Mint Street decided to stick to the script. The Monetary Policy Committee, headed by RBI Governor Urjit Patel, left the repo rate unchanged at 6.25%, even as it hiked the reverse repo rate by 25 basis points to 6% in a bid to suck out the excess liquidity.
Our endeavor will be to 1. Drain out the remaining liquidity overhang, manage the new drivers of liquidity in 2017-18, and 3. Ensure that the normal requirements of liquidity consistent with the needs of a growing economy are met.
Ever since demonetization, a lot of cash has found its way into the system, so much so that there is now excess money supply in the Indian economy, which is not just in contrast to the neutral policy stance of RBI, but can also stoke inflation. And which is why the policy has focused on removing this excess money by variable reverse repo auctions, operations under market stabilization scheme, open market operations, cash management bills, variable rate repo, reverse repo auctions, and the Reserve Bank of India has even urged the government to clear amendments to the RBI Act so that the central bank can open the much talked about standing deposit facility window. But despite global concerns easing, the central bank is still wary about inflation rearing its ugly head once more. In its own admission, retail inflation will be at about 4.5% in the first half and 5% in the second half of this fiscal. The RBI fears that uncertainty around southwest monsoon with an El Nino probability, house rent being passed of pay panel, one-time effect of GST, high government deficit accentuated by farm loan waiver, and the possible commodity price rise given geopolitical risks will stoke inflation further.
Inflation developments have to be closely and continuously monitored, with food price pressures kept in check so that inflation expectations can be re-anchored. Accordingly, the future course of monetary policy will largely depend on incoming data on how macroeconomic conditions are evolving.
In fact, the upside risks are so high, and in the absence of any big disinflationary event, RBI believes meeting 4% target may be a challenge. Resolution of bad loans found a mention too, but the possibility of high core inflation and the excess liquidity in the system is what the policy clearly centered around.